Okay, welcome to TSAA SF, the Charles Cottle portion. Okay, I want to first start off, well, I'll break the little ice with a little joke that, actually it's a true story, it's not a joke. Some people might not think it's funny. It's actually, well, but it's got some numbers in it. So there's some math. You're all brilliant people, mathematics. There's timing in this little story. There's a 70-year-old guy, an 80-year-old guy, and a 90-year-old guy in front of a nursing home on a bench, and they're just chatting away. So there's some numbers there, 70, 80, 90. Those are crucial here. So for you mathematicians, get ready. The 70-year-old guy says, I feel pretty good. I just wish I could take a healthy number 1. The 80-year-old guy says, well, I could take a healthy number 1. I just wish I could take a healthy number 2. Okay, you got your calculators out? The 90-year-old guy said, well, I could take a healthy number 1 and a healthy number 2. Why, just this morning at 7 o'clock, 7 on the dot, I took a healthy number 1. At 9:30 on the dot, I took a healthy number 2. My problem? I just wish I could wake up before 11. So timing is everything. Okay. All right, now, I heard a lot of comments today that I disagree with, but that's okay. For every trade, there's an opposite side of the trade, isn't there? So I don't believe you can use options for day trading. So I'm not going to play for 30-cent move on the Qs. If you're a day trader, I would rather trade the Qs. The bid-ask is narrower, so you don't have the problems that were raised. And you're only going to ride it for 20 cents. What's the point? I mean, the bid-ask differentials can eat you alive if you're day trading with options. So options are more for week trading or month trading, right? So, you know, trade that way with options. And so I'm going to show you, parallel channels and I'm going to show you symmetry, and I'm going to show you that my screen keeps blacking out, but that's just my version over here. Hang on, let me just adjust this so it doesn't keep doing that. Yeah, luckily, right. All right, and so those are first couple of precepts that, first and foremost, I was a market maker starting in the early 80s, 28 years ago. I want to introduce Don Gerstein, who was back there in 1981 with me when I started, and so was Dr. J. We were clerks at the same time, and it was mentioned that I was the co-founder of Thinkorswim. Tom Tsaasf was my clerk at one time back in 1981. So I then went on to the Board of Trade. After trading before the OEX started, I gave that job to Tommy when an opportunity was offered to me. And he went on to go and trade in the OEX, and I went off to the bond options and traded on the Board of Trade. And after about a year and a half there, I formed a partnership with a big market-making company, or rather a big clearing firm, and I started the Shack and Cottle Group, and I grew my traders to about 20 traders. And I went over to the CME, and I had traders over there, and I traded in every single commodity options pit myself first, and then handed my position off to an underling, trained him, and then I had seats on all 3 exchanges at once, and I used to drive the car to wherever my position was the busiest, wherever the delta got out of hand. Deltas are important to a market maker. All the stories in this book are derived originally from my market maker book that came out in '96. It was written to train market makers, and that's what I used to do with Tony Saliba, and traveled all over the world training market makers when they started the new exchanges. And then I was, after I left International Trading Institute, I wrote that book, and then I was doing private consulting and helping people with their derivative debacle positions. I anticipated all the caca that was happening in the market recently, but back in those days, you just hired Arthur Anderson, who I hoped would hire me. That's why I wrote the book, so that they say, Charles, get this guy out or neutralize him, because that's my real forte, defensive trading. And but they just called Goldman Sachs to say how much to get him out, and Goldman Sachs would give him pennies on the dollar and take the position, just like what you've seen what they did with Bear Stearns and everybody else. And that became the culture. And then, you know, all these OTC traders that I was, you know, all these OTC trades that everybody wanted to do at these banks when I was training market makers. And I thought, boy, this is ridiculous. This is going to blow up. You know, this counterparty risk is really scary stuff. But then along came IIG and put me out of business again because they insured everything. Nobody needed to know everything that I needed because they were insured. Well, lo and behold, the walls came tumbling down. So we'll see what happens in the future. So then I moved to England because I was doing some work with Tommy and I. We bought, and some other guys, we bought gold mine in Africa when gold was down at $250 an ounce. And so I spent some time trying to do business down in Africa and not being a native, and everything's twice as much. Anyway, that's another story that I'm not going to go into. And then I came up with this idea while I was living in England called, which eventually became Thinkorswim. And what was I trying to do? I was trying to fill the void of what was missing that the professional option trader had over the retail investor and hedge fund traders and those kinds of things. They didn't have the tools. So there's what you see in that platform. And I had a guy, one of my proteges, who was my programmer for me at International Trading Institute, and my assistant, and Eric Forsyth, who's the lead developer now at TradeMonster, he came from Thinkorswim. I brought him in over there, and he designed that beautiful system over there, and then he left, and now TradeMonster has the benefits of his talents, and you're going to see some amazing stuff coming out of TradeMonster as it evolves. Thinkorswim got quite a head start, but TradeMonster's got some great things going for it. So maybe I'll pull up that platform, but actually I'm going to pull it up tomorrow because I'm doing this for 5 hours tomorrow, not this, but you'll see what I'm leading into. I have a workshop for my own private clients tomorrow. If you're interested in that, after you see what I got to show you, you can talk to Donnie up there, register, and the people who went to this get a little bit of a credit rebated back to them or a discount because they had it here first. So I'm not trying to compete with them, but you know, if you're on the level of what we're going to be into tomorrow, which I don't expect many or any of you to be, you're welcome to come and do that too. And if you can't make it, logistically, I'm going to try and simulcast it. Sometimes when I move the mouse, it kind of trips up my voice, but I'm recording it, and that'll be all clean, and that will be available for download as well, including that feed. All right, so, and I stayed on board with Thinkorswim for a few years, and then I realized that some of the things that I wanted to build were never going to get built. We have a little parting of the ways and ideas, and I wanted to go off, and you're going to see some of the tools that I don't think they'll ever build because they're very pragmatic. Tommy, who runs the company, ran it up until Ameritrade bought him, but still runs the software end of it. You know, what they already use, that's what we're going to build. We're not going to build any dream machines. So it is dreamware for most people because they don't know about it, but the people who are my main followers, a few thousand people, they like the stuff and they use it every day, and you'll get a chance to get a taste of that. All right, let's see. So, yeah, so my focus turned to retail investors, and when I was with Tommy, we reprinted, we carved out a lot of the market maker stuff, took it out, and we printed up coulda, woulda, shoulda, gave it out free to anybody open an account, and a bunch of PDF versions, and it stripped out all the market maker stuff. It stripped out all the, a lot of the graphics. There were about 200 graphics in there, and I found out that some of these folks that we were training, you know, and were our customers, boy, they are smart folks. You guys blow most of the public out of the water. And what I've always kind of hated about the exchanges, they always dumb it down. They always, you know, they teach really basic stuff, and they don't get more advanced. They don't expect anybody to get more advanced. They expect them probably, unfortunately, to you know, run out of money before they have any chance of getting advanced. And my stuff all starts out very advanced, except for the brand new course that's coming out tomorrow or the next day. We're going to launch it on Wednesday, actually. It's a brand new video. It's like Walt Disney on options. It's, you know, it's got cartoon characters and animation, and it takes it from what is a call, and you know, it's not maybe for most of you, but it's in conjunction with Biz Radio and their audience, Jack Barugian, where I'm on the Ask the Risk Doctor segment every Wednesday morning for a half an hour, 10:30 Central Time, and ask questions. Ask the Risk Doctor. Okay, I think I've covered all the beginnings, so let's get into this. In the immortal words of more famous CC than I am, Carol Channing, diamonds, diamonds, diamonds is what she professed. And my three D's are diamonetrics, which you're going to see. It's technical analysis for options strategies, and diversification and discipline. Okay? So the objective of this presentation is to show you diamonetrics. It's technical analysis. So you're going to see a lot of charts and a lot of correlating information that will blend well with some of the earlier speakers and maybe blend well with what you already do in technical analysis. All right? And then we'll breeze through a bunch of patterns that I'll show you. And I'll show you a brand new tool that does this very easily that we've developed. And then we'll open it up to any questions. Anything on any options question, I'll try and field it. If I don't have the answer, I already do have a forum on my website. So let's see, though, that's the new website that gets launched Wednesday. So you won't see this particular one, you'll see my old one. But if you go to riskillustrated.com, in the meantime, you'll see about 1,800 pages of Q&A, of real positions that real people have. Now, I have about 270 hours of videos that we sell at riskdoctor.com. There's a bunch of sample free stuff, but 50 hours of it is actual courseware with curriculum, and about 220 are live coaching, all recorded, where whatever you had on, I talked about it that day. If you had a graph, it's in this forum. I've uploaded it, and I respond also with an illustration. So when that book, I don't know where it went, here it is. There's like images that I put up from it in answering these questions, and let me get it back up here. It keeps jumping out of my way here. All right. When I wrote this, I took the original Market Maker book and Coulda, Woulda, Shoulda that added an email dialogue with a guy out here at Market Maker on the Pacific Coast, actually, he was, who was turning to retail kind of style investing, not carrying inventory like market makers, selling as many things on the ask and buying things on the bid and managing their inventory, which I still work with market makers on the floor and train them and coach them on their give them second opinions on their adjustments and their different impressions of vol level and everything. But when I rewrote this after I left Thinkorswim, I brought back all that imagery because you guys are so smart, and I don't dumb anything down. And I tell what I do instead is, when you buy calls, you make money when the market goes up. We know that's not true, but theoretically it is. And then I footnote it and say, but it loses most of the time because of premium erosion and volatility getting crushed and everything. So the biggest value in my book is all the footnotes, the exceptions to all the rules. And the theory is way nuts compared to the reality, which is the difference between profit and loss. Okay, so let's try and, let me give you a little bit of a background. I'm just going to try and do this in 5 minutes. Just go through what this book covers that no other book covers so that you'll realize it's, first of all, it's loaded with market maker stories. My trading positions, like times when I had to run out of the S&P options pit and run around because my broker went to have a smoke, and I've got 100 to sell because I just did 100 calls and 100 puts in the option pit, and I physically was running, and as I was running, I was looking up at the board, and it wasn't moving by nickels, 0.05, it was moving by dollars every time, against me on 100 that I had to buy. It moved 9 points before I got into the pit, and a guy was there in the back month that I had to trade, and he's smiling, and he gives me a $2 wide market, and timeout. Once I went into the back month of the bonds to do the same thing, to buy a spread between the bond, or no, I went to buy back month bonds. I've had over 100 futures to buy, and the market was 10, 12. And so I middled it, 11 bid. They just said at 12, and I changed this to an obscene gesture and walked out of the pit. 12 seconds later, I'm running back in, paying 17 after not taking the 12s, and I lost 5 ticks on that. Time back in. So this guy gives me a 32-34 market on the futures, and I had 100 to buy. I just said, remembering that one, buy him. He's laughing as he's carting it up, and I walk out of the thing licking my wounds, figuring I got killed for a couple $100,000. Turns out I made 70 grand on the trade still, even though I gave up 9 handles on a 100 lot because the options were so out of whack. It's like a field day. It was actually on my birthday in 1986 that this trade happened. And this guy who was laughing turned around to hedge it off this Dees against Sepp, and it went against him like 8 handles also. And so that smile turned quickly to a frown. Okay, so let's see. Ooh, what happened to my, there it is. All right, I made a moment. Let's look at the pages here and reduce this a little bit. Reduce. Okay, let's go to, I want to show you a few things. Page 29 in the PDF. So this is the same thing. All right. Whenever I show a position, okay, is that big enough for everybody to see, this image? All right. Anytime I show a position long, it's left of the line I write it. Anytime it's short, it's to the right side of those vertical lines. Now, the calls are all on the left, and the puts are all on the right. All right, and we write the stock or the futures up at the top. So that's the formatting, if you see anything later that I did. So I'm just, giving you just a precursor to that. All right, now, here's a position. Just look at these positions for a moment. This is the 50 and 55 strike. Calls are on the left, $3 and $1. Puts on the right, $5 and $2. So as somebody was talking about the box earlier, you can see that the box adds up to $5. The call spread's $2, 3 minus 1. Put spread's $3, 5 minus 2. All right? And this is a position of long and short calls and long and short puts at different strikes. Now, what I teach and what I help people manage positions on is making them look at their positions differently because they behave differently once they look at it differently. Like some people who do covered rights don't realize what Dr. J was saying, it's naked short at put. Well, if I put on a cover right or I have a customer that's put on a cover right, I have them watch the put only. That's your position. Watch the put. Because if it gets down to a nickel, it's not worth being short anymore. Buy it back. Roll it up. Do something. Roll the call up. But so I get them to look at it different. And if we look at that position differently, it will look like this. There's 6 ways to look at that position. All 6 of these, if you had 6 brothers in the room and each brother had one of these, they'd all have the same destiny to the penny, give or take their little transaction anomalies. So in other words, this 20 by 10 by 40 by 50 is the same as, look at the lower right-hand corner to section 5. It's like a ratioed straddle short at the 50 strike. Somebody was saying about market makers, they have premium short at one strike, premium long at another strike, delta, gamma, vega, theta, neutral, that kind of stuff. That's what this is an example of. Or you could see it as a put ratio spread against a callback spread. So I'm not going to dwell on this. It's not the topic. I'm just kind of painting the picture. I show people how to, and we have a nice video series on this, where you're long the underlying, and there's 4 basic hedges that go into the middle. This is the options metamorphosis, goes into the middle. The most common one is what you see in quadrant 2, turns it into a short put, or a married put turns it into a long call synthetically, or twice as many calls sold against it turns into quadrant 3, a short straddle, and twice as many puts turns it into a position, a long straddle, taking advantage of a move in either direction. Now, by the way, I don't teach straddles so that they could go and make money if the market goes in either way. I teach straddles for a totally different reason, to show how they work. And once you see how they work, 99% of the time you stay away from them, long or short. And what Dr. J said, I really like what he said. He says he likes verticals, and verticals will be your bread and butter, especially because it's pretty close to what you do and you don't even realize it. And gosh, I wonder if I can even show this little video. It's a 1-minute video on the website. Let's see if it even plays on this thing. Let's see. Home. Yeah, there we go. It's the second video here. This is real basic here. Okay. What are options? That's not the one I want. I want the next one. The types of options. This one. And I'm going to make it full screen. A vertical has a minimum value of 0 and a maximum value equal to the distance between two strikes. The expiration. Now that looks like what you trade. Looks identical to the 45-degree. That looks like long stock or long futures, doesn't it? Long underline. If you zoom in between the strikes. If you zoom out, you can see it's got a floor and a ceiling. Now I'm just going to stop that if I can. And okay, now how many people go home with positions long or short in futures? Because most of you trade futures or stocks. Go home long them. How many go home long? Are you day traders? Hold your hands high. How many go home with the positions? Yeah. Futures, just straight futures. Who goes home long them? 1, 2. How many go home long or short stock? A little bit more. How many, all right, so for you guys, a natural is to, I mean, how often does it happen at the end of the day, gosh, I wish I could just stay long till tomorrow, but I can't afford that exposure. What if you put a floor in to your long position and a ceiling that pays for the floor, sell the call, buy the put, and now you're hedged just for overnight. And now you have something that was this that is now like this. You bought the put for protection, you sold the call to pay for the put, and now you're there. Or if you were short, you know, it's the opposite way. You're short, right? You put in the floor, you sell the call, so now it's that. And then later, if it works out for you, like a long call spread, you could sell a call spread against it, and now you got a butterfly. And so it's the evolution of a trade, just like the options metamorphosis. When that position on page 63 was in the middle, it evolved to, oh, that got blown away. Okay. Hello. Okay, 63, right there. So it can evolve, like in quadrant 3, it can evolve to a butterfly, like in number 5, where you put in the floors. But there's a lot of ways into that butterfly. In fact, didn't show you this, I'll just rewind. Here's 10 ways to achieve a butterfly. All of these are one of those at the same strike. The same 45, 50, 55 strike, that list of 10 of them. There's a gazillion ways into it. So, you know, it's like playing golf. Follow the golf ball. If you hit it into the woods, you don't drop another one unless you're a cheater. You follow it into the woods and hit it from there. You follow your position and it evolves. Okay, moving right along. I want to get to the good stuff. I got all the Greeks in here. I think Greeks are important, and I think delta isn't your most important one. I think just as important is the rate of change of that delta. It's gamma, the change of the change. Delta's change. Gamma is the rate of the change of the change. And then theta is an important one too. And especially if you're portfolio trading, I profess to have some stuff aiming north, some stuff aiming south, and some stuff aiming sideways, and maybe some explosive positions. And that's what we're going to construct tomorrow. And I do believe in paper trading until you're ready to trade, until you get it. And so tomorrow we're going to find trades that I'm going to say, okay, I'm going to show you these charts. They're either going to be bullish or bearish. And I'm going to have the audience that there's only about 35 or 40 people coming tomorrow so far. And so we'd like to have more of you. And when we get there, we'll take a poll, and, maybe we'll put on both. The people who are bullish on it, the people who are bearish on it, whatever. I don't make any stock recommendations, so I get around it by having you do it, and then I'll tell you what you're doing wrong from that point forward. I'll tell you what you're doing right. I'll thumbs up you. I'll tell you what you're doing wrong that you could do better. Here's an example. I have a new service that's coming out called RDSOS, Risk Doctor SOS, Second Opinion Service. A couple of weeks ago, somebody Twittered me back or Facebooked me, and they said, Charles, Citibank's going over 5. It's going way over 5. And the 5 calls are cheap, 38 cents. So in a series of going back and forth, I said, wait a minute. 38 cents is cheap, huh? All right, stock's at 460, right? Yeah, okay, 460. Ready? Keep these numbers in mind. 460. 5 calls, 38 cents for October expiration. I said to the guy, well, do you think it's going to the moon, Alice? Do you think it's going to 7 or 8? And he says, no, just way over 5. Well, it's got to get 38 over 5 to break even, right? But anyway, I tell him, you know what a reverse stock split is? He goes, yeah. I go, okay. Reverse stock split 10 to 1. Now we're talking about a stock that's $46, not $460. Now we're talking about a strike that's not $50. It's not 5, it's $50. And now we're not talking about 38 cents, we're talking about $3.80. Let's pull up another $46 stock that's got a strike of 50 and see what that's going for. A buck. Synthetically, a dime if there was a 10-for-1 stock split, right? So I showed, this is an astronomical price, 38 cents. Oh, sure, 38 cents in your pocket, that's dirt cheap. Especially if you're giving it to a beggar on the street. It's like you gave him nothing, right? So, that was the first thing. Then I said, okay, you haven't answered really how far you think it's going to go, but do you know that the 4-5 call spread, the bull spread's going for 47 cents? I mean, it's 60 cents in the money. Sit still, you make 13 cents. It grows. That's the kind of debit that actually grows over time. So that's what we talk about. That's the same as selling that put spread, the 4-5, that would be going for 53 cents because of the box. So I dwell a lot on those relationships. And I show them right here in this reciprocal relationship that was alluded to earlier. It is right over, momentito por favor, bitte warten, here it is. There it is. The red slashes are the put spreads. The blue slashes are the call spreads. Add them together, you got the box. Okay? So, yeah, one or the other. You could have bull spreads that are call spreads. You can have bull spreads that are put spreads. So a long call spread or a short put spread. Well, anyway, okay, sorry, Alex. These are both. This is just showing that the put spread and the call spread.
Bearish and bull and bull.
Bull and bear. The blue is bull. The put is bear, and they add up to flat. Okay. So, and this is what shows what happens over time. I'm not going to dwell on this image, but I will say that I said, okay, if you buy the 4-5 call spread and you're right, you're going to make the remaining from 47 to 53. You're going to make that 53-cent profit. And it's more appropriate because that strike that you're buying, I'd rather sell it. It's astronomical. There was a big skew. Speaking of skew, does anybody know what skew is? Dr. J said it's the vols between months. I look at it as vol between strikes. So there's a whole chapter here on skews, and it's a skew library of all the different, let me just increase this so you can see it. Enlarge. Okay, that's large enough, and I want to go to pages 281. All right. So a lot of people who buy this book, believe it or not, they buy both, the hardcover, because they don't like dragging their computer to the bathroom. And it's a handy thing. You could zoom in, you could search, but it's a nice feature, especially for old men with prostate problems. Anyway, like me. No, God forbid. All right, let's see. I want to give you just a, where is that? 280. There we go. All right, look at these four over here. These are bear spreads. It's the same bear spread, same strike, but the P&L profiles are different according to what the skew is. Whether it's a, let's see, you're on that side. So call skew, put skew, or a put skew, call skew. In commodities, it's that the calls are, let's see, it's the calls that are on the moon, like in oil, soybeans. The out of the money calls are successively higher, and the puts are cheap. And in the stocks, it's the other opposite way. Why is that? It's not because of market opinion or anything like that. It's because that's where the hedge is. That's where the hedge is. If you're long stocks, what are you going to do? You're either going to sell calls, that puts pressure on the calls, that hammers the vol, or you're going to buy puts, married puts or covered rights, or you're going to do both. You're going to collar it. Either way, boom. And the market makers who buy all the calls from you, they're wearing them all, and the ones that they sell to you, they're short them up the wazoo. They're always bidding for them back. So there's always a bid for them and always an offer for the calls that keep that relationship depressed. So this shows you that certain strategies are not appropriate in certain markets, or they're an extra bargain because you get a discount when you're going that way. Anyway, because of the skew in Citibank, I recommended buying the 4-5 call spread instead of how many, okay, if I buy 10 at 38 cents, that's $380, $38 each, 10 of them $380 for a 10 lot. Let's go with a 100 lot. It's cheap. $3,800, right? All right, somebody divide 47 cents into 38. 3,800. What's 47 into 3,800? It's somewhere around 90, something like that. That's how many call spreads, somebody yell out the answer when they get it, how many call spreads you could buy instead for the same dough. Now, what happened, you saw Citi, and you know, I might as well pull up a chart, one of the diametric grids that we're going to be doing. Citi. You know, back here in October, you know, it never made it to $5. It was dead wrong. But my spread didn't make a lot, but it was over the cost of 47. It expired like at 460. It made 13 cents, and his got totally toasted. Okay? And I would have told him in my second opinion service, buy 90 of these instead, you'll be better off. So it's not a trading recommendation, and so I don't get, you know, accused of any of that, but it does, you know, give a more appropriate strategy for the play. Okay, you know, there's more I could show you in the book. I'm not even going to bother with the book anymore unless it comes into context. Let's go right to the diametrics and what that's all about. Okay, so why diametrics? Why diametrics? All right, there's bulls and bears at any given time. There's bull trends and bear trends, even in the same underlying. And I try and identify where the bulls are intersecting with the bears. The bull channels crossing over bear channels. And where they intersect, there's a likely expiration range. What's that good for? Possibly not a directional play unless it's at the south end of a set of channels or the north end for a bearish play. But for a likely expiration range where they're duking it out and neither one can take charge, and now that's conducive to either a butterfly or a condor or a broken wing or some kind of wing spread, long the wings, short the middles or the bodies, or a calendar or a combination of the two. A calendar against, if you have a calendar and you do it against a butterfly, now you have what they call a double diagonal. In other words, it's like short a straddle in the front month, one of these, and you buy a straddle in the back, a strangle in the back month, further back, and now that's sort of like a butterfly, but it has this time element. It's got embedded calendars in it. And why would we do that versus a regular butterfly? Implied volatility is low, perhaps. When vol's low, calendars are the better way to play sideways. When volatility is high, butterflies are a better way to play calendars. Why? When volatility is high, butterflies are cheap. Doesn't mean it's a guaranteed play, and I heard something about, oh, I do this all the time, and you can't lose. Oh, come on. I don't believe in that. Google, last expiration, the at-the-money butterfly, 1 day to go, $10 butterfly, right? I think it was at 520-ish, right? Okay? The 510, 520, 530. If it goes out at 510 or 520, that thing's going to be worth $10. It's $1 with 1 day to go, risking 1 to make 9. It lost. It went out worthless. It shot 20, $17 or $20 in 1 day, or $30, on the expiration. Poof. Another time, here's an image from the book. I'll go back to the book now, because we're right. Google. We once played Google, and it was during a live demonstration of my book, actually, and that is page 189. So this is the way I used to draw diametrics, but now I have a cool tool that I'm going to show you. So I projected an expiration where that blue oval was. It happened to be, we were up at 295. This projected 260, 280, 300. The bottom of that oval is 260. The top of it's 300, and the middle's 280. So I said it's going to 280. This is the only time it's happened to me, folks. It landed exactly at 280. To the penny, during a live webinar. It landed right there after we bought that butterfly for $6. Okay? But that wasn't the lesson. And we ended up only doubling our money on it. We sold it for 13.5. We worked out of it. And I'll tell you how I did that in a moment. But that's not the important thing. The important thing is Thursday before expiration, that $20 butterfly, this was a $20 butterfly, was trading at $17.80. Who would buy something for $17.80 with 1 day to go that can make the remaining $220 or lose $17.80 on a surprise announcement? Nobody would buy that. Guess what? They should have, because it won. It went to $20, to the penny. It went. But, it's not realistic to even trade that. But what I taught and what we played for is we bought this butterfly, and I teach people dissection. These black in the middle, 10 by 20 by 10, long, short, long, that's a butterfly. Embedded in it are these little baby butterflies that we can harvest. And we harvested some of them, and we took some off. So when we got to 290 on the way down, we took off the 290 baby butterfly. When we got to 280, we took off some of those. It went down south, and it came back north, and we were trading against the inventory. As a retail investor, we were doing that. And I have a spreadsheet version. This is the old spreadsheet version. The red, the blue, and the green show the same iteration of the red, the blue, and the green, these stages. So I teach you by hand. I teach you by the spreadsheet. And now, boy, we've developed a full-blown version of this dissector that is like on steroids. It's called Risk Illustrator, and it's got live prices, live price feeds, and all the dissection and baby butterfly prices, and it's way beyond the information. I'm not going to talk about it anymore today. But tomorrow, when we find these trades, just like the last time we did this, we put on a bunch of trades, and then Monday they got filled in the paper trading system, and then we managed them, and I had to leave town in 2.5 weeks, so everything was adjusted for the next several days or liquidated, and in 17 days, we made a modest 14% for the 2.5 weeks. It's not a lot of money. It's not, huge, but it's a nice, I try and teach my folks, my followers, to make 2 to 3% a month. The good ones make 5 to 10. The stars make 20 to 50 to 100% a month. Okay? But the only thing I do is I raise their options consciousness. I show them about their gammas, their vegas, their thetas, their dissections, their intersection, their rolling, their hedging, their adjusting. But today, I'm going to stop talking about all that, because tomorrow and for the rest of the day, I'm just going to show you the charts that show you your entry. And I'll just tell you this, that whenever you find any trade, there's two things that rule. One is, what do you have on that you put on? What strategy is conducive to your opinion? Okay, and then what are your action points when you say, I'm wrong, and you have to get out or adjust it or change the beast, change the animal? Okay, that's the key. That's the key right there. And you have the discipline to get out. But if you're diversified, you got some aiming north, you got some aiming south, those can start to be relaxed a little bit. And what makes it even relaxed more is if every position that you put on is limited risk, And most of them are limited gain because the trade-off, when you do limited risk only, that means you have unlimited gain. It's costly, it's data, it's negative, it's time erosion, it's money wasting every day. You've got to be right, you know? So rather than have to be right, I like the trades where you can be wrong and still make money. So I tend to go more for the high probability trades, that if you're wrong, you can still make money. Okay, so how do you do that? Well, you could do it with credit spreads, you could do it with butterflies, you could do it with double diagonals and calendars and all sorts of things with your adjusting and everything else that these 1,800 pages in the forums have tons of examples of. And it's not the kind of forums where you talk to you and you and you're telling about what you did on the weekend. I delete all that. I edit even when you don't use capital letters and everything. It's been mostly edited. It's not 100% perfect. I got to get a team of university students to edit it, index it all and print it into 6 books because that's how much information there are in these forums. But I have the last word on everything unless one of my rocket science students jumped in there first and said, Charles would say, da, 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 and I go in and say, thumbs up. That's what I would have said, or I would add this. But I have had the last say on almost everything. Not because I'm a control freak, but just because I want to get it straight. I want this to be the source of everybody's questions and answers. Okay, so we worked out of those butterflies, and we harvested the baby butterflies. And at one point it looked like this when we sold off the 10 of the green ones and we're left with the 10 blues. The actual position remaining was 10 by 30 by 20. That's that skip strike fly that somebody was talking about earlier. And I'll show you another cooler skip strike flies just to show you where you could take this consciousness. And then here it is. The first one, the pink one is a regular butterfly, 1 by 2 by 1. Skip a strike, 1 by 3 by 2, the blue. That's the one that was talked about earlier. What about 1 by 4 by 3, the red one? What about 1 by 8 by 7, the green one? Those are all skip strike butterflies too. It's basically trading 1 vertical and financing it with 7 verticals to pay for it. It's sort of a chicken way of, a scared way to play ratio spreads, if you know what those are. Ratio spreads look like this, unlimited loss, right? So you just lower it, but you have limited exposure. And then you can even change the ratios where it goes under the line, but it's still limited. So what I say is do everything limited risk so you don't have a chance of getting scared out. If you already know that you can totally lose the amount that you put towards that one position of those 10, say, 3 aiming north, 3 aiming south, 3 aiming sideways, one, explosive move. If you've got the, no more than 7% of your account, some people modify that to 5% or 3%, per, of your account on any one strategy, then even if you get pummeled on one of them, it's limited risk. You don't even have to get out. You don't even have, if your action point is blown through, you still have a chance that it can come back and bail you out. But the thing is, you don't have to get out of it because it's limited risk. It's like you're automatically out. You just wait till expiration, and poof, it goes away through the exercise process and all that. So that's what you do when you trade. Okay, so let's go to this story. So why Diamonetrics? So I told you it aims for the likely expiration range. Why ranges? Because they're high probability, limited risk trade, short premium, and you could do all these different strategies on stocks, equities, index, currencies. I've traded them all. I told you I was a market maker in all 3 exchanges. I've tried all this stuff in all 3. The only difference between the options pricing models for futures versus equities versus indexes, all of them, is slight things that affect reversals, conversions, and boxes, and those are market maker things where they have 10s and 15,000 on and big amounts, and so 3 cents makes a big deal to you. 3 cents is nothing. And pay 3 cents to get in is nothing too. Pay the ask if it's only 3 cents away from the, it's cheap. I don't profess, when you're doing a vertical, if you've done all your homework, you say, hey, it's time to get long, I won't put it into the bid. I'm not gonna try and save 3 cents when I'll miss a boat after all my homework tells me that I need to be in this thing. I'm not gonna screw around to save a nickel. I want in, okay? I want in, but I'm not going to day trade it, so I'm not going to flip myself out of it and, churn myself in 3 days. I'm playing for a bigger picture, a longer term thing, at least 3, 5 days, a week. I like the stuff in 50 days. All these expirations that I have are for D's. They're like 35 days away. All the examples. All right, now here's the thing. I use something, instead of trend lines, I use wick zones. It's my own little invention, wick zones. It's sort of like cheating. So I'm going to go into an example of wick zone and what the consciousness is of it. Here it is. All right, now, what do we see here? We see, I want you to focus on the 3 blue bars first. That's a bar chart or a candlestick or whatever. Now, you people who like inner trend lines will use that red line, connecting the bottom in column M in this Excel spreadsheet to the top of perhaps in P. Or maybe you'll even go like this. You'll even rock it up. You'd rather do it there. Trend line it there, right? Connect this bottom to this top, inner trend line. Another person might take and just connect the tops, 2 tops, for whatever, there's certain trend lines from technical analysis even better than me. Some lines are valid, others are not, In other words, when you have higher highs and higher lows, you can't connect a higher low unless that high takes out the previous high, right? It's an invalid line otherwise, right? But either way, however you form your trend lines, what I do, this green is more like a wick zone, where I find a compromise and I include both of them. So look what I have. I'm connecting both of them. So I have nice fat zones and they're transparent. So you can see them. So what you're going to see in all my charts are wick zones. And usually it's the wicks of the candlesticks. Now, I'm not Steve Nissan and I don't do candlestick charting. I mean, I know what doji stars are and all that stuff, but I'm not looking for that. I'm looking for symmetrical and parallel channels. All right, so with that, here, let's look at a few examples. And there's a number of them here, And what do I say? Drink no wine before it's time. That's probably something I should say at the end, so I'll skip it at the end and just say it now. All right, so we got to wait until our thing is set up. So when here we go. These are, I solicited my visitors for tomorrow. They turned in about 31 favorite underlines. Remember, I go off what you, the audience, you, my public, wants to trade, right? And you've picked, or they've picked, 31 or 32 different underlines, and I'm in the process of drawing grids with the most recent charts on them. I use profit finance charts because I like log charts. I noticed the previous speaker, Mr. Lehman, was using log charts. I don't know if he mentioned that, but I noticed that the prices on this axis here, where the prices were narrower and narrower and narrower the higher you go. I believe in that as percentage moves. So these are all log charts. I go out 2 years, and when I have to, out 3 years, because I'm looking for a longer term play. Some of my students, they use Diamonetrics for, day trading, all right? But that's their thing. All right, so what do we got here? These red rectangles and these green rectangles, this is just me showing you, identifying it. This is not part of the software. Let me just show you the software real quick. Let me entertain you. Okay, just pulling up a Word doc. There's probably an interesting link here I wanted to talk about what's in here. This is whatever. Okay, here's my software. Boom, you see it. It's see-through. It's a window that comes up over any technical analysis system you're using or any pasted-in chart. It's just a see-through window, and I can move my grids around, and I can change the slope of my channels, and I can change the thickness of my wick zones, and the little skinny ones you see are half channels that a lot of positions. So I use these because I don't want to see any violations. So this is the versatility of this tool. So it works with any technical analysis, whether you're CQG, whether you're in the Thinkorswim. Huh? Medicine, anything, anything. Worked with a photograph of your mother, which I have plenty of pictures of. You can make the down channels fatter than the up channels. You can rotate this thing, tilt it. Okay, so this is my tool, all right? And it's got this little measurement device so that no matter what you're using it on, it will tell you all the slopes and everything and all the coordinates that are in your picture there and the size of your screen and everything, so that if you pull up one of these grids that's 2 years old, you'll be able to overlay it, because I maintain, and here's why symmetry. I think that, well, let me ask you, how many of you skip around doing a lot of different underlyings in your trading? Okay, a few. How many of you stick to the same issues, the same underlying most of the time? Do you believe that the whole world, most of the trading world's like that? Do you know that even if somebody's at Deutsche Bank or UBS, because I trained them, right? They always trade IBM only, almost only, you know, and maybe 10 others. There's a guy devoted to that stock. There's a guy devoted to those futures. So it's always the same players. You know, you get a tip on something, what was that website that used to be, I don't know, during the dot-com boom, ragingbull.com. You know, everybody who's long tells you, oh, you got to buy this, whatever. You know, I still get these goofy penny stock emails. Anyway, you know, it's few and far between where somebody will, oh, I got a tip and they're going to go trade this. I don't mind tips. I love Dr. J's calls, but I throw them into Diamonetrics first. I always have, I mean, I'm a vol studier too, but I use vol levels, not so that I could put on a high probability sit still trade in the blind. I find a reason to be long it, short it, sideways-ish, or explosive. And then, because I determined that through Diamonetrics, no matter what their tips or reasons are, whatever it is, I'll look at what you got, I'll look at what you got, I'll look at what you recommend, I'll read your newsletter, I'll see that, but I'll pop it into my thing and see if I can now own it for my own reasoning. We live in a cause and effect world. Be the cause, not the effect of somebody else's call. Make it your own, then put it on. Then it's not his anymore. It's not his or hers to blame once you messed it up. Oh, they told me to get long. Oh, he said it was going up. Only go with it and own it even if it goes down, but own it yourself. Be the cause, not the effect. Okay. Yes?
Have you done Diamonetrics on Warren Buffett's puts?
On his puts? I don't chart puts. I chart only underlines. I mean, you could chart options. I think it's a total waste because there's vol that enters into it, but I chart implied volatility. I'll put those implied volatilities that you saw from myvolatility.com. I'll throw those and run Diamonetric grids to find support in implied volatility, and that will only tell me that if I found a range, now I got to decide whether it's a butterfly or a calendar. If vol's low, generally speaking, it's a calendar play. If vol's high, generally speaking, it's a butterfly play. All right, so let's look at some of these things as we go into the close and let everybody go home. Let me just... you have another presentation? Oh, I didn't know that. I thought I was last, dude. Cool. All right, well, I'll get off and make room. All right, let me go through these, and let me go through the logic of it. Okay, so what do we got here? Look at the... something looks... Okay, let's look at the first down-sloping stuff in the red. You'll notice that it stays in that channel until it busts out and it goes up to the next channel. Okay, it doesn't have any violations. Whenever there's a little mini violation, I circle it with a little red oval or a circle. But you can see that it loves this pattern. So I'm pointing at it now. It broke this wick zone. It's going to break one eventually. I mean, time will tell, but it's going to break one or the other. And the dominant trend is usually the one that's going to hold. You know, the discussion with the triangle before, yeah, one's really the parallel channel and the other's just pretend or make-believe or fake, as he said. So it busts this. It doesn't go back up into that channel. It busts it, it stays up there, it comes down, it holds. Now, where the hell does this thing come holding here? This is a projected out in the future place that there was no, it's a symmetrical, going the exact opposite way at the same slope. It knew where it was going to come to, and that was a good buy, to either do the vertical legging into a butterfly or something, buying the bull spread at that point, or selling the put spread, which is a bull spread too, or you could even go long calls if bow was cheap, and then lay off the rest and spread it off and turn it into a butterfly at this point. When it got up to here, how did it know to stop here? How did it know to stop at that point? Diamondmetrics is sort of, it's got like this, I don't know why it works. For the first 18 years that I used it, I couldn't really, I wasn't consistently profitable, just bullish and bearish. Okay, do I got to wrap it up?
Yeah, unfortunately.
All right, I'm just going to click through these, and we could talk about it tomorrow, but here's Citibank. Here is EEM, FCX, all of them, and the blue oval is expiration range that I'm predicting. GE, Gold, IBM, NTES, RIM, RUT, Silver, SPIES, USO, Apple, and that's, I haven't done Apple yet. Thank you very much. Oh, I got to stop this. It's right here in this room.
What time?
It starts at 10 to 3. We'll break for lunch, and I'm having flown in from a block away from Subway, because that's the only place open for a mile.